This is a weekly podcast of our average Indian investor. Welcome to the deep dive. So imagine you're, say, 27 years old. You're starting to earn reasonably well, maybe around a lakh rupees a month, and you're thinking, bigger picture, building wealth, maybe even retiring early.
Exactly. But, there's so much noise out there about investing. How do you actually figure out a path that works for you?
Yeah, navigating all that can be tricky.
That's what we're getting into today. We'll look at the whole journey, really, from just starting out, figuring out mutual funds, maybe planning for those big goals like retirement.
And specifically, let's say that goal is retiring a bit early, maybe around 45. That changes things.
It certainly does. And we'll even touch on, okay, you built this corpus.
Yeah.
How do you actually use it later on?
Right. So we've tried to pull together some clear, practical ideas here. The goal is really just to help you cut through the clutter and get some actionable steps for your own financial journey. Okay, let's unpack this. First off, being in your late 20s, you have this incredible asset. It's just time.
Oh, absolutely. It's the biggest advantage.
Every rupee you put to work now has years, decades potentially to grow. That compounding effect is just powerful. It's really the foundation building time.
It is. And the key thing to leverage that time is, well, discipline, starting now. A really good target to aim for initially is saving and investing, say, somewhere between 20% and 30% of your monthly income.
20 to 30%. Okay.
Yeah, it's often seen as a balanced range. You're building wealth, but you still have money for, life today.
So if you're earning that lakh a month we mentioned, that's like 20,000 to 30,000 a month going towards investments. Roughly.
Roughly, yes. Obviously, everyone's situation is different. Expenses vary, but it gives you a concrete number to think about.
Makes sense.
But before you really start putting larger amounts into mutual funds or stocks, there are a couple of crucial steps, non-negotiables, really.
Okay, what are those?
First, your emergency fund. That safety net. You need enough cash set aside, somewhere easily accessible, like a savings account or maybe a liquid fund, to cover about 6 to 12 months of your essential living costs. This protects your investments if something unexpected happens, like losing your job. You don't want to be forced to sell investments at the wrong time.
That's critical. And the second thing?
Tackle high-interest debt. Seriously.
Yeah.
Credit card debt, personal loans, anything charging you, like 15%, 20% or more.
Yeah.
That debt is costing you way more than you'll likely make on investments consistently. Get rid of that first. Now, lower interest debt, maybe like a home loan, that's often different. You can usually manage that alongside your investing plan.
Okay, so emergency funds sorted, expensive debt cleared, then linking this saving habit back to why you're doing it, those goals.
Exactly. Visualizing retirement, maybe buying a house, whatever it is, that gives your saving a purpose. Makes it easier to stick with it.
Especially that early retirement goal at 45 we talked about, that requires serious planning.
Definitely. And here's the accelerator. As your income grows over the years, and hopefully we'll try to bump up that savings percentage, don't just spend the extra income. Invest more. That's how you really progress towards financial independence.
Right, increasing the amount you invest consistently. Okay, so foundation is laid. Now, let's talk mutual funds for this 27-year-old. How do you decide where to put the money, this whole asset allocation thing? Why does it depend on age?
Well, generally speaking, your ability and maybe even your willingness to take on investment risk tends to decrease as you get older. When you're 27, you have a long time horizon. Decades, potentially.
So you can afford to ride out market ups and downs more easily.
Precisely. If the market takes a hit, you've got plenty of time for recovery and growth. A very common rule of thumb, not a strict rule, mind you, but a starting point is a rule of 100.
Rule of 100.
Which is subtract your age from 100.
Okay.
So for someone 27, that's 100 minus 27, which is 73.
73. So that suggests maybe around 73% of your investment could be in equity?
Could be, yeah. As a rough guide, equity generally offers higher growth potential, but comes with more risk, more volatility. The rest, that remaining 27% or so, would typically go into debt instruments, which are generally more stable, lower risk.
Okay. So for that equity part, for a young investor who can handle a bit more risk for potentially higher returns over the long term, what types of equity funds should they look at?
There are several categories, and a mix is usually a good idea for diversification. You've got large cap funds. These invest in the biggest, most established companies in India. Think of them as providing stability and consistency, lower risk within the equity space generally.
The blue chips, kind of.
Kind of, yeah. Then you have small cap funds. These invest in much smaller companies. They have the potential for really high growth.
But more risky, right?
Definitely more volatile. Lots more ups and downs.
Yeah.
You absolutely need a long investment horizon for these, like 7 to 10 years minimum, to ride out those cycles.
Okay. What else?
Mid-cap funds sit in the middle, investing in medium-sized companies. They often offer a balance, maybe more growth potential than large caps, but less volatility than small cap.
A sweet spot, potentially.
It could be. And then there are flexi-cap funds. These are interesting because the fund manager has the flexibility to invest across large, mid, and small cap stocks, shifting the allocation based on market conditions and opportunities.
So that gives you built-in diversification across different market sizes.
Exactly. It offers balance. So for a 27-year-old starting out, putting together a portfolio with maybe a large cap fund, a mid cap, perhaps a small cap if you have that long horizon and risk appetite, and a flexi cap, that could be a solid diversified start.
That makes sense. But then sometimes you see people with like 10, 15, even 20 different mutual funds. Is adding more and more funds always better?
Good question. Not necessarily. Diversification is crucial, yes, but over-diversification can actually be a problem.
How?
Well, if you own too many funds, especially within the same category, you might end up just mimicking the market index anyway, and your potential for outperformance gets diluted. Plus, it becomes much harder to track everything properly.
Right. Too much complexity.
Exactly. Often it's better to choose, say, 4 or 5 good funds across different categories that you understand and have conviction in, and then just increase your SIP amounts in those funds as you save more, rather than adding new funds all the time.
Okay, stick to a core set and build on it.
Yeah.
Are there other fund types worth considering if someone wants a slightly different approach, maybe beyond those initial 4?
Sure. You could look at multi-cap funds. These are mandated to invest a minimum percentage in large, mid, and small caps, so you get that guaranteed exposure across the board. Or if you're a bit more conservative, maybe balanced or hybrid funds.
How do those work?
They invest in a mix of both equity and debt within the same fund. So they tend to be less volatile than pure equity funds because the debt portion provides a cushion when the stock market falls. Good for moderate risk takers.
Okay, lots of options to build that initial portfolio. Now let's fast forward. You're doing the SIPs, maybe increasing them as your income grows. You're in your 30s, maybe early 40s. That target of retiring at 45 is getting closer. How does the strategy need to change then?
This is a really critical transition phase. As you get closer to a major goal, like retirement, especially an early one like 45, the focus has to shift. It's less about maximizing growth at all costs.
And more about protecting what you've built.
Exactly. Capital preservation becomes much more important. You need stability. So the strategy is to gradually, systematically reduce your exposure to higher risk equity funds and increase your allocation to safer, more stable debt funds.
How do you actually do that shift? Just sell equity and buy debt?
You could, but doing it gradually is usually better to avoid timing the market badly. A very effective tool for this is a systematic transfer plan, or STP.
STP.
Yeah, you can set it up, say, maybe 2 or 3 years before your target retirement date, so around age 42 or 43 in this scenario. It automatically moves a fixed amount of money from your equity fund to a chosen debt fund, maybe a liquid fund or a short-term debt fund every month or every quarter.
So it smooths out the transition.
Precisely. It helps you lock in the gains you've made in equity over the years and move that money into safer assets as your retirement date approaches, reducing the risk of a sudden market crash, wiping out a chunk of your savings right before you need it.
That makes a lot of sense. Okay, so you've hit 45, you followed the plan, built up a good corpus, used STPs to shift a significant portion into debt funds.
Yeah.
Now, the big question, how do you actually live off this money? How do you generate income from 45, potentially for the next 30 years, maybe till 75 or even longer?
Right. This is where that debt portion you've carefully built up becomes your workhorse. It's there to provide regular income. The mechanism for this is typically a systematic withdrawal plan, or SWP.
SWP. So STP to get the money into debt, SWP to get it out.
You got it. With an SWP, you instruct the fund house to pay you a fixed amount, say, whatever you need for your monthly expenses, maybe $50,000, maybe 1 lakh, depending on your corpus, and needs directly from your debt fund units on a specific date each month.
Like getting a monthly paycheck from your investments.
Exactly like that. It provides a steady, predictable cash flow to cover your living expenses during retirement. The money comes from your debt fund holdings. And hopefully, the remaining corpus, perhaps still with some conservative equity exposure, continues to grow modestly over time to combat inflation.
So that SWP from debt funds is the key to generating that income stream for potentially decades.
That's the standard approach, yes. It allows you to draw down your corpus in a structured way.
Got it. So investing clearly isn't a set it and forget it thing entirely. Managing the portfolio over time seems crucial too. What's involved there?
Regular review is definitely key. You don't need to check it daily or weekly. That can lead to panic decisions. But sitting down at least once a year to review your portfolio makes sense.
What are you looking for in that review?
You're checking if your investments still align with your goals. Have your goals changed? Is your risk tolerance still the same? How are the funds performing compared to their benchmarks and peers?
Right.
Is your asset allocation still roughly where you want it to be, or does it need rebalancing?
Rebalancing, meaning if equities have shot up, you sell some and buy more debt to get back to your target percentage.
Exactly that. Or vice versa. It helps manage risk. But the big caution here is, don't make frequent changes based on market headlines or your own emotions. Getting greedy when markets are high or fearful when they fall.
Easier said than done sometimes.
Oh, absolutely. But patience and discipline are probably the most important traits for long-term investing success. Stick to your plan, especially during volatile times. Trust the process.
We hear about diversification strategies too, like maybe using low-cost index funds for the core part of your portfolio and then maybe some actively managed funds for potentially higher returns.
Yeah, that's a common approach, the core satellite strategy. Index funds or ETFs give you broad market exposure at a very low cost, forming a stable core. Then you might add satellite holdings, perhaps actively managed funds, in areas like mid or small caps, where a skilled manager might have a better chance of adding value, of generating alpha.
So be smart about where you pay for active management.
Right. Consider costs, those expense ratios. They definitely eat into your returns over the long term. For something like large cap investing, where it's harder for active managers to consistently beat the index, a low-cost index fund might be very efficient. But for potentially less efficient markets like small caps, paying a bit more for potential expertise could be worthwhile if you understand and believe in the manager strategy.
Makes sense. Focus on what you can control, saving consistently, asset allocation, costs, and your own behavior.
That sums it up well. Patience, faith in the future, discipline. Those are the keys. So just to recap the main ideas, start as early as you can. Be disciplined with your savings. Make SIPs your best friend. Align your asset allocation more equity when you're young, like 27, gradually shifting to debt as you near that retirement goal, say 45. Diversify, but don't overdo it. And review your plan periodically, maybe annually.
That's a great summary. And maybe a final thought for you, our listener, to take away. We spent a lot of time talking about building that corpus, reaching that magic number for retirement. But maybe spend some time thinking about the other side, too. How exactly do you envision using that money over potentially 20, 30, or even 40 years of retirement? How does thinking deeply about that withdrawal phase now influence how much you save and how you invest today? Something to mull over. Thank you so much for joining us for this deep dive. You can catch further episodes of Your Average Indian Investor on YouTube or Spotify. Please like, share, and subscribe if you like our content. We'll see you next time.